On February 23, 2026, a massive 7,000-word Substack post by Citrini Research unexpectedly triggered a broad equity sell-off. By the closing bell, IBM stock had fallen 13%, its steepest single-day decline in a quarter century. The iShares Tech-Software ETF simultaneously hit a 52-week low. The Citrini report, titled The 2028 Global Intelligence Crisis, explicitly labeled its models as a scenario rather than a definitive prediction. But financial markets do not liquidate billions of dollars over hypothetical fiction. They react when a documented mechanism aligns with something structurally true. The sell-off occurred because institutional investors recognized that a massive AI-driven contraction in white-collar labor is already operational. The mechanism Citrini named is the human intelligence displacement spiral. As companies integrate artificial intelligence into their daily workflows, they extract significantly more output from existing staff. When entry and mid-level employees leave, their routine tasks are absorbed by those augmented teams. The position is simply retired. This creates a ghost workforce. These are jobs eliminated entirely through hiring freezes and non-renewals, rather than public redundancy notices. Those displaced workers stop spending, consumer demand falls, corporate revenue drops, and companies are forced to cut further headcount to fund more AI integration. Because these individuals never receive a formal layoff notice, they are not counted as unemployed. A structural labor crisis is accelerating while remaining completely invisible to standard government metrics. The scale of this invisibility becomes obvious when you examine the labor data from 2025 and 2026. This chart shows the official corporate reporting. On the left, we see that in 2025, companies formally attributed only 54,836 layoffs to artificial intelligence. However, cross-referencing labor analytics reveals the true figure of displaced positions is between 200,000 and 300,000. MIT researchers have confirmed that AI models can perform the work equivalent to 11.7% of the entire U.S. labor market, specifically targeting finance, healthcare administration, and legal support. We can track this contraction through hiring rates. Between 2023 and 2025, entry-level tech hiring dropped by 30 to 50%. The vast discrepancy between the official layoff numbers and the actual disappearance of roles is a deliberate corporate obfuscation strategy. Companies reclassify widespread displacement as organizational efficiency. White-collar work is built on a highly specific task stack: document review, data formatting, basic code documentation, and report generation. In 2026, AI executes these routine tasks with high reliability. Firms deploy these tools directly to their senior and mid-level employees, allowing them to instantly generate the preliminary work they used to delegate. This flowchart illustrates the non-refill mechanism. As firms deploy AI, tasks are absorbed by the existing staff. When a junior employee departs, their role is deprecated rather than backfilled. In the post-2022 market environment, institutional investors heavily reward efficiency and margin expansion. Knowledge worker headcount is highly visible in corporate filings and lacks union protection, making it the easiest target for executives looking to satisfy board pressure. As these roles evaporate, the affected demographics stop spending. That drop in consumer demand puts revenue pressure on the exact same companies that just automated the jobs. Each individual firm's decision to cut costs is rational, but when executed collectively across the economy, it creates a self-reinforcing, catastrophic feedback loop. Every major stakeholder benefits from keeping this contraction quiet. Corporate executives secure higher earnings per share without triggering regulatory backlash, while governments maintain the political cover of technically low unemployment metrics. AI software vendors have the strongest incentive of all. To sell enterprise tools seamlessly and justify massive valuations, they must insist their products augment human workers rather than replace them. This narrative was carefully manufactured. In May 2025, the CEO of Anthropic explicitly warned of a white-collar bloodbath, projecting that AI could eliminate 50% of entry-level jobs within 5 years. By May 2026, he entirely reversed his position, claiming AI simply makes everyone 10 times more productive. That exact pivot occurred simultaneously with Anthropic filing confidential paperwork for an IPO targeting a $1 trillion valuation. Sam Altman and OpenAI made the exact same rhetorical journey on the exact same timeline. The sudden industry-wide shift from sounding the alarm to promising job creation was a financial necessity. They could not raise capital at trillion-dollar valuations while simultaneously holding liability for a global labor crisis. This displacement extends far beyond the U.S. market. India produces approximately 1.5 million engineering graduates every year, the largest technical talent pipeline on Earth. For 3 decades, this pipeline directly built the Indian middle class by serving as a global human labor arbitrage. U.S. and European companies offshored their IT and process execution for a fraction of domestic costs. Artificial intelligence is simply the next layer of that exact same arbitrage. It performs the same process execution, but at zero marginal cost. By fiscal year 2026, the absorption mechanism broke. The top 5 Indian IT firms recorded a net workforce decline. Companies like Wipro slashed their entry-level hiring guidance from over 40,000 recruits down to less than 8,000. Multinational corporations are opening new global capability centers in India, but those roles demand complex AI integration skills and deep product ownership. The millions of fresh graduates are trained for a legacy IT ecosystem that is no longer hiring. India's economic engine relied on being the cheaper option. But human labor, regardless of geography, cannot compete against a technological alternative that costs nothing to replicate. Economic historians have documented this precise pattern before. Between 1780 and 1840, the British Industrial Revolution triggered what is known as the Engels Pause. For 60 years, the deployment of new industrial technology caused GDP and corporate productivity to skyrocket, while real wages for the working class actively stagnated and fell. Internal market analyses from entities like Microsoft explicitly state that we are entering a new AI-driven Engels Pause right now. But instead of targeting factory workers over a 50-year timeline, this transition is compressing the impact into a single decade, targeting accountants, software developers, and paralegals. The companies currently optimizing for immediate margins are incurring a massive structural debt. By eliminating their entry-level cohorts today, they are entirely destroying their pipeline for senior leadership by 2030. While history suggests the macroeconomic picture eventually stabilizes, the intervening decades of transition will systematically hollow out the current white-collar middle class. At this moment, no U.S. federal framework exists to track AI displacement or mandate worker augmentation. This complete policy vacuum ensures that the displacement remain invisible in official economic reports. That vacuum is beginning to close. The European Union has already classified employment AI systems as high risk, and institutional asset managers like BlackRock are beginning to include AI workforce impact in their ESG screening protocols. Applying compliance costs to the 92 million jobs at risk, the workforce policy software market reaches $85 billion by 2030. Firms spending over $1 million on AI must contribute a 3% reskilling levy and undergo a $150,000 annual augmentation audit. The entities that build this tracking and audit infrastructure before federal regulation arrives will control the data that defines the labor market. The Citrini market crash was the moment investors recognized the scale of the ghost workforce. The tools that measure this displacement are now a structural requirement for any company trying to manage the transition.